This market, it's not the easiest to find deals.
It's not a good world, but it's probably the easiest method in real estate.
I think our generation are renting for a lot longer than previous generations.
So what is the very first step to start investing in real estate?
I think the first step is finding your niche.
Hi guys, welcome back for a new episode. Today, as you can see, we're in a new environment, New York City, with a very good friend of mine, Jonathan Zarka. How are you doing today?
Thank God, everything is good. Thanks for having me on the show, Adam.
Thank you for accepting my invitation. It's really a pleasure for me. So we're gonna be 100% in English today. Usually, we do in Quebec, we do it in French. But yeah, it's fine. New York, English. Perfect. So if you guys don't know John, he's obviously in real estate. He's the founder of Lightrock Management. He's doing basically acquisition, management, location, rentals, basically everything related. You're gonna explain. So yeah, if you wanna just start, just to present yourself, how did you end up in real estate, basically?
Yeah. So first off, I'm honored to be on the show, getting into the Canadian market. So a little bit about us, Lightrock Management. We're in the business of buying, owning, operating, redeveloping, and managing apartment buildings in the Northeast, primarily Connecticut and New Jersey. So I guess the passion for real estate started back when I was a kid. My father was in the business on the fix and flip side. So he would buy single 1 and 2 family homes, short sales and foreclosures, and they would fix them and sell them. And so I guess I always had a passion for seeing how the construction process would take, what it would look like, what the house would be, start to finish. And it just grew that passion, and I always kind of knew I wanted to get into it. So I want to say back when I was, a little bit younger, in 2017, I started working on the acquisition side for a local New York City developer that focused on building market rate housing in New York, the Bronx, Brooklyn, Manhattan, Queens, and then from there just kept going. So brokerage side, and then to the sponsor side.
So you mentioned I saw a post of you on LinkedIn saying that you're starting to in the constructions to see how it works.
Yeah.
Why did you guys change to owning more multi-residential property instead of doing flip? Is it like a very different aspect?
So I guess growing up, I was always used to the way my dad did it, which was buying, fixing, and exiting. And so I guess I saw that side of it, and I wanted to get onto the side of more of a perpetuity. So owning an asset, fixing it, and then keeping it long term, and letting that asset just appreciate over time. So whereas opposed to when you go into a deal sometimes and you're planning an exit, 12, 24 months down the road, when you're fixing these assets to keep them long term, you're really trying to do as much as you can to make sure that the asset is going to perform well without too heavy or too much maintenance and capital expenditures throughout the management process.
Okay, great. So on that, can you walk through your acquisition process, like from acquisition to exit?
Yeah.
Just to explain us how you guys do it.
Yeah. So first off, it starts with sourcing the deal. So actually going out there, looking, finding it. Especially in this market, it's not the easiest to find deals.
Yeah.
With rates being where they are, and just it definitely takes time. So a lot of it's working with brokers, a lot of it's cold calling on our end as well. Finding that deal, then actually going, touring it, underwriting it, making sense of it from a financial standpoint, and then going forward with the deal. So generally taking on debt, depends on the deal structure. So some deals will go in with bridge if we know there's a heavy construction period up front. Some deals will go in with standard financing, going in, taking on financing, fixing up, marking the units to market. Okay. So oftentimes will buy older buildings that have a lot of deferred capex, meaning the current owner who's selling it hasn't done any sort of improvements to the building in years. So you'll walk in and you'll see like the floor is all tilted and the roof falling down.
Is it something you look at first? Is it like your first criteria before buying a property, you'll say?
Yeah, we want to see what we're getting into before we're getting into it. So we want to know like what the scope of work is going to be when we're going to buy something before we actually do it. So yeah, making sure that everything's going to work, bringing everything up to date, and then generally marking the rents to market. So oftentimes these old buildings where haven't been fixed in years, rents are really low, owner hasn't cared about the building in years, and then we'll come in and really fix it up. Not just for us, but also for the tenants, for the city, for the communities, and generally make that building, like transform it from what it was into what it is, and then, operate it.
Okay. So basically you live in the city, you live in New York, but if I understand correctly, you're not investing in the New York state, right?
Correct, yeah.
Is there any specific reason?
So I guess when I started out on the buy side, it was back in the end of 2020, beginning of 2021. So towards the beginning of COVID,
yeah,
which no one was working. And so we were looking for other markets where we saw a trend of people. We wanted to know, I guess, where the people were going. So I started tracking population movements across the tri-state area. And we saw that a lot of people were leaving the city during COVID because everything was shut down. There was nothing to do here. And they were going to Jersey, Connecticut, a few Pennsylvania, but mainly Jersey and Connecticut. So cities around New York City that are accessible within 30 minutes to an hour via train. And so that's kind of what we followed. We kind of had an inclination that, rents would generally grow when there's a big influx of people. And so we started looking for those markets, and that's how we ended up in Jersey and Connecticut.
So Jersey, Connecticut. So the main reason is always looking because of New York. So you guys saw like people leaving New York and mostly going to those two states. Is there any other states maybe you're looking, or is it like for now you just like focusing on two states? And yeah, because it's two big states, right? So
yeah, there's a lot of markets in each state. I feel like each city within the state is its own market in itself. For now, we're in those two markets. We've looked into Atlanta a bit, Atlanta, Georgia. We haven't looked at much of the Sunbelt states. I think what's happening across a lot of the Sunbelt states, so Texas and Arizona and all the places that money rushed to during COVID, have a little bit too much of an oversupply right now. I think Jersey and Connecticut, the fundamentals have always been good. So there's a lot of people still moving into these markets. And so regardless of, 5 or 10,000 units being built in these markets, they're filling up still pretty quickly. So I want to say for now we're in these two markets. Maybe we'll go elsewhere at some point, but we're happy where we are at the moment.
Sure. And in terms of pricing, is it very different from the state of New York? I mean, probably because you guys went there. But is it like very different from any other states around the New York state, like maybe 1 hour drive?
So I want to say I think pricing in Jersey and Connecticut are probably more competitive than New York these days. Reason being is just there's, I guess, a difficult political landscape in New York, which makes a lot of what I do out of New York not necessarily feasible or financially economical to do here. So you do actually see that after 21, a lot of the money from New York has started moving to Jersey and Connecticut. So deals are trading at probably more compressed cap rates out there than they are here. So for example, in Brooklyn, you might be able to find a 6.5 cap or a 7 cap, very limited upside. In Jersey or Connecticut, you might be buying a 5 cap or a 5.5 cap, but you have that upside component for at least the product that we're buying.
What is the volume you have at the moment? Is it like if you don't want to give the exact number, it's fine. But is it like less than 100? Is it more than 100?
Yeah, so right now we're below 100. I hope to get into the mid hundreds in the next few months. We're working on a lot of different deals right now. We're really trying to grow the business and expand. But we own a few different buildings throughout the markets. We're managing ourselves as well. So we built out an operation on the management side. We do construction oversight ourselves. So we're not hiring GCs, but we're really overseeing the entire process. And I think just when you're involved in every step of the process, you can really make the asset perform to its maximum capacity.
So basically you do everything inside, right? In-house, sorry.
Yeah, besides for leasing, which leasing and underwriting we do in-house. Leasing we generally give to brokers within the local markets who can market it and show it, but everything else is done in-house.
Right, so like this was my next question, because as you guys are mostly in New York, all your properties are, as you said, like minimum 1 hour drive. What is the challenge regarding that? Like, because you have to go also on site, but you have people also on site. You do, as you said, like leasing. So you still need like to give like some time to those properties, no?
Yeah. So I try to go out there every so often. It depends on how much construction we have going on. So when construction's, at a heavy point, we'll be out there twice a week, 3 times a week to check to see what's going on. I also have different people locally that will go and oversee to check on construction or management or make sure the building's taken care of. We have a lot of local people who do our management, so we're not actually going out there and doing the repairs. For example, let's say a tenant needs something fixed. I'm not driving out to Jersey, but we'll have people locally within that market fixing it, taking care of the issues. And then our management team will follow up, make sure the tenant's happy, make sure the issue is closed out. So yeah, it's definitely not the easiest thing, but it's not too tough to get in the car an hour, 30 minutes, 40 minutes.
I mean, like for the volume you have, but let's say you're expanding at this moment, I think you're gonna need to have at least like 1 or 2 property manager, let's say on site. Maybe you're gonna hire someone leasing, someone like to do like how would you say like if you have any problem with the tenants.
Okay,
jurists. I don't know how to say it in English.
Landlord, tenant, yeah. So so management. I personally don't handle management anymore. I have somebody who's head of management.
Okay.
She's actually out of Phoenix, Arizona, and she runs all the back end management. So dealing with tenants' maintenance requests, dealing with evictions if we have them. Hopefully we don't have them. Dealing with collections, dealing with leasing, dealing basically with anything on the management side. So she does all of that. And she's out of Arizona, so she's not near. She's not going to the properties. But it works. We have enough people locally to check up on things and to make sure they're running.
As soon as you have someone checking on the building, it's anyways everything. As soon as you have maybe a construction guy or maintenance guy on site,
correct. Yeah.
He can do the janitor type of deals also. So I don't know. Like everyone has his own management, depending on how many units you have. So
I think management works best when you have somebody, at least in my opinion, when you have somebody locally who's actually doing the work, and then you have somebody who's dispatching that individual, and then also following up with the tenant to make sure that whatever they needed done is closed out. Because sometimes it gets lost in between where like tenants reaching out directly to the super and they're not doing their job, and it's hard to get, I guess, a higher level individual involved. So I like to run the process like tenant has a maintenance request, they sign onto their online portal, they submit the request on their computer, we send somebody out, we fix it, they'll take a picture, and then we'll close it out online and follow up.
Okay, great. On the management side or maybe constructions also, what is like the most unexpected thing you saw maybe before buying or when you renovate a place? Do you have anything in mind maybe?
So generally, before we're buying these buildings, we're trying to do like cameraing the sewer line. So it's oftentimes a big thing. I think it's overlooked. A lot of the buildings we're buying are built between the 1900s to 1970s or 80s. So it's really C and D class product. And these buildings, the pipes get really, really old. And people go in and they don't realize that excavating an entire sewer line from the building to the street is a really big job. So we'll camera the sewer lines, we'll get somebody up on the roof. Oftentimes I like to go on the roof, so I'll go check up to see the condition of the roof when it was last done. We'll look at the main things like boilers, floor joists, structural, so kind of like big factors. If the kitchen doesn't look good or bathroom, we know we're going in and fixing it anyway.
Right.
But I want to say the main structure of the building, the bones, the mechanicals, all that type of stuff.
Okay, perfect. Another question I had was, let's see. Yeah, so on the investment side, what is the best investment strategy you find most effective? Let's say, I'm going to give you some example. Rental, short rental, buy and sell, real estate, cross-funding maybe. What is like the best thing for you on your end?
I want to say in general, value add multifamily. So buying buildings where your tenancy is going to stay for, at minimum 12-month periods, where we can go in, keep the asset long term, mark the rents to market, fix any sort of deferred CapEx. That's generally what we look for. I've looked into industrial a bit. I've looked into hotel conversions and office conversions a bit. Yeah. There's a lot of office space all over New York, New Jersey, Connecticut that just underperformed and not being used. I think multi in general, I think is here to stay. People are always going to need somewhere to live. And I think our generation and I guess the younger generations are renting for a lot longer than previous generations. So I think back in, the people who were born in the 50s and 60s and 70s, they were quick to go find something to buy and live there and raise a family. I think now what you're seeing, at least in the United States, is that people born in the 80s, 90s, 2000s, they're planning on renting for a lot longer. And even people who make enough money to actually purchase a home want to be in a city where there's some sort of action or nightlife. They can go out, grab a drink, have dinner. And so they prefer to rent in those markets and not have to worry about fixing a house and doing landscaping or anything like that.
No, I agree with you, because everyone needs a home, right? As you said, so it's probably like maybe it's not a good world, but it's probably the easiest method in real estate to grow. When you compare to hotels, for example, it's in the aspect of investing, banks, finding loans and everything, like hotels, it's quite difficult compared to multi-residential. I don't know if you agree.
Yeah, I think hotels is like its own business a little bit. I think finding debt on multi is pretty easy, even though it's gotten a lot harder since rates have went up. So there's a lot of like regional and local banks that have been pulling out. And so recently we've seen rates drop in the past, I want to say 2-3 weeks, pretty substantially. So you're now starting to see like agency debt come back in. But industrial is also a good asset. We've looked at some industrial deals. We haven't performed on one yet. We've looked at mixed use in markets where we think the retail component, is strong. But yeah, hotels is definitely its own animal.
Yeah. So next question, sorry, is how do you choose the property to invest in? Is there any like specific? We talked about a bit before, but is there any like specific factor you're looking at, or is it only like based on deals mostly?
I guess two things come into play. Financials. So can the deal perform? Can we make ourselves money? Can we make our investors money, most importantly? Can we do good in the city that we're in? And then also which cities, so location, safety, who's moving into these cities, why they're moving into the cities. Generally, when we're looking at buildings, we want to be able to increase our rents from their current place and mark them to market. And we generally want at least a spread of 30 to 40%. I want to say probably that's one of the main factors. The other factors like safety. So we don't want to go into a market where we don't feel safe to operate in. So we want to make sure that there's, some sort of police presence, that people feel safe out there, that we feel safe to go out there at night if we need to, even though we're not going out there at night too often. So yeah, I want to say those are probably the main two: safety, the people moving there, and then also, can we get rents to where they should be?
Right. Yeah, this is one of the main factor.
Yeah.
And do you guys want to keep your properties for, let's say, like short, long, 5 to 10 years, or are you more like looking to, we did a good deal, let's sell and find something else?
So I want to say a combination of our deals. So we do two things. Sometimes we raise capital on deals. So we'll bring in limited partners. We'll have a pref and promote structure. And so those deals we look at on a 5-year to 7-year hold, but oftentimes the capital that we're raising is pretty long term. So as long as the deal is performing well, we're making money, everybody's generally of the consensus to stay in the deal. And then the other way I look at deals is sometimes we'll buy them more, family oriented. And so those deals will look more long term. I want to say in general, we look at these deals, 5 to 15 years, but we don't have any exits on most of them. Generally, we look at our refinance. So when we bring up our value, we're looking at as our refinance as like a capital recapture for everyone involved in the deal. And if we can capture enough or recapture our capital back on that refi, we'll generally keep the deal pretty long term if we can.
And invest in another one after.
Invest in another one, raise more money on the next deal. So I guess because of the raising component, we're not like constrained to just turning our own capital into deals. If we can make sense of the deal for ourselves, we'll bring in equity partners, and I guess deals are unlimited if we can find them.
Right. Yeah. I mean, the most difficult thing of the job is finding the deal.
Yeah.
Right.
Yeah.
So and finding the money.
I think the money comes if you find the deal.
Okay.
I think if you have an honest sponsor, someone who's performed a few times and whatnot. Oftentimes, people look to give those type of people money. So thankfully, we've been fortunate so far. I'm not going to have the easiest time to raise on deals, but it hasn't been too difficult. But I think you find a good deal, the money finds it.
Right. Yeah. Okay. So we're starting to arrive at the end of the podcast. Thank you again, Jonathan, for accepting my invitation. I just have 2 quick last questions for you. So the first one is for any new person who's looking to invest in any type of situation, but mostly in real estate. It can be like in Montreal, and can be in New York, Connecticut, anyways. So what is the very first step to start investing in real estate for you?
I think the first step is finding your niche. So deciding what you want to get into, whether it's multifamily, whether it's hotels, whether it's industrial, whether it's student housing. I think just finding what you want to do, which type of asset, and then also within that asset class, finding, what type of product you want. So if you're getting into the multi-sector, do you want to be in value add? Do you want to be in development? Do you want to be in core plus housing? Do you want to be in short-term rentals? So there's so many different aspects of real estate. So kind of just finding what you enjoy, because I think when you enjoy something, it makes it a lot easier to do it. Like I wake up and I love this stuff. I have a passion, a drive, and just go out and do more. But I think finding first what you want to do, and then just kind of getting out there and speaking to everyone asking people questions, listening to like amazing podcasts like the ones that you run.
Thank you.
And just getting as much information as possible and just going out there, starting to look for deals, getting whatever softwares you might need, speaking to brokers, just really getting in the market. And I think it, you know, if you have a desire to do something and you can push yourself enough, it takes time like everything else, but eventually you get there. Yeah.
Amazing. Okay, last one is, so can you recommend a book or a podcast for our listeners? So basically the question is, are you more a listener guy or do you read a lot?
Good question.
Or
I don't. I definitely don't read a lot. I read the paper. I read the Wall Street Journal. I like to read the real deal to see what's going on. I do read books also. I want to say what I found most important, and it's not even real estate focused, is a book by Dale Carnegie, if I'm not mistaken, How to Win Friends and Influence People. I've also been listening to this podcast called Founder, just on business. Mm-hmm. So I think business in a whole, whether you're in real estate or any other business, I think a lot of it boils down to psychology and how to deal with people. At the end of the day, business is dealing with another person. And just knowing how to deal with people, how to negotiate, and looking at people who have done it way better than I have and seeing what have they done or what have they learned through their process. So I want to say great podcast is first Adam's podcast, and then also the podcast Founder I found very helpful. And just really understanding of how people think, how people negotiate, why they negotiate, right? Like sometimes pricing is not everything. Sometimes there's different things that move the needle. Maybe it's speed of closing. Maybe it's getting close to the seller or close to the broker and building a relationship. So just learning how to deal with people. I feel like in school we're really not taught that too much. But yeah, through books, like I said, podcasts, Founder, How to Win Friends and Influence People by Dale Carnegie. There's just a bunch of different reads that you can find.
I read this book, very good book.
Great book.
I think I didn't finish yet, but yeah, most of the part, yeah, I read, yeah, very good book.
Yeah, I think business, whether you're in real estate or a different business, it's the same thing. Maybe the functions of it are different, but like how to grow a business, how to scale, how to hire, these are all really important things. And whether you're, you know, in the agriculture business or real estate, you have to deal with the same problems.
Yeah, how to influence also people, but not in a bad way, in a good way.
In a good way,
how to communicate with them. I think it's the most important part also.
Yeah.
Thank you so much, Jonathan. Once again, thank you for sharing everything. As you know, guys, like, comment. If you have any question, don't hesitate with us. Thank you so much for watching. Thank you again, Jonathan, and I'll see you on the next one.
Thank you for having me on, Adam. Appreciate it.